So you'll be able to have this at any time.
Okay.
So we're gonna start off with supply and demand. Supply and demand, liquidity. Gonna need trend. And then you're gonna need to know a retracement. And order block. And then some of the abbreviations, which we like BOT, which stands for break of trend. We have BOS, which stands for break of structure. And then we have CMP, which stands for current market price. And there's IPA, which is impulsive price action. Impulsive price action. So yeah, I think these are the major ones. I think another one I should have added is, I think we should first start off with pips or points. Pips slash points. Or some actually like to call it price. Yeah, so these terms here are one of the mostly wide used terms when it comes to the market. And you'll hear these in different rooms and, you know, different people, different traders. Some of them may have different names. Some of them speak to them in different terms, but these are like the universal terms. So basically pips and points, pips, points, price, you know, levels. That's basically a value measurement from A to B, you know. So in this instance right here where you see your price and everything, this is and basically an indicator of how you can measure these pips and points. So basically pips and points is just like a measurement, you know, from point A to point B. It's like a kilometer, you know, it's like a meter or so. And so in instance, when people can say like the market moved, let's say like 30 pips in a bullish area. So also know that when people refer to bullish, it refers to an uptrend, the bulls. So the bulls are always the uptrend. You see, the bulls are the buyers. It's always the buy side. And then the bears, when the market is bear, if you hear that term a lot, if the market is bear, it means that the market is selling or is you know, is depressed. The market is depressed. You see, so when people say, so for instance, this price moved from 12,037, and now the price is here by 12,315. So in this instance, when we look at the pips, if there's a decimal, then you're gonna have to count it a pip lower. So in this instance, it will be that the market basically moved in about 70 to like 100 pips 70 to 100 pips. So from this point to point B, it can be like 100 pips. And that is how basically people measure from point A to point B. You see that? And that is all used by the terms pips. You see, like, you're not really gonna need to know pips that much unless you're really like measuring your trades and you trying to be analytical with your entries. But yeah, it's always a good thing to know like what a pips are, in case you start hearing that, you know, across. So then we're gonna get into our next big thing, which is supply and demand. You see, so supply and demand, supply and demand has two variables to it. So where there's supply and demand, there's always a discount, you know. So the supply can be discounted and the demand can be discounted as well. You see, so for example, you have to find out where your levels of supply and demand are. So in this instance here, in this wide range, we can measure that. So supply will be either your highest or lowest point, same as demand, just depending on the scenario and what's going on in the market. They can work vice versa to each other. So it's in this situation where we have the supply and the demand. So what is between the supply and demand is liquidity, you see. So whatever is in the middle of supply or between supply and demand, or whatever separates supply and demand, is always liquidity. And that liquidity either needs to go from the demand and reach the supply, or it needs to go from the supply and reach the demand. And then once that liquidity is filled into the market and is reached either one side, the banks will come and collect all of that liquidity in there, because the liquidity is there in order to be collected. You see, that is there in order to be collected and taken. So in this point, we have the premium supply and the discount supply, or the premium demand and the discount demand. And between the two, how you differentiate between the supply and demand is that there's only a 20% difference between the supply and demand. So if you go into any shop, any store, and they're giving you a discount price, the discount will usually be about 20% from what is the actual price. So it's basically governed on like a 20% rule. If it's anywhere below the 20% rule, it's basically a sell-off. You know, it wouldn't be such of a discount, but it's like a sell-off or a sale or something like that, you know. So in this point, once we start to see where the supply and demand is, we need to identify where the liquidity is and where the liquidity is coming in from. So liquidity, you know what liquidity is. Liquidity is just funds. It's just floating funds that are available for anybody. So once you see where the liquidity is, you're gonna start identifying the liquidity by the trend. You see that? You're gonna start, the trend shows you where the liquidity is. So wherever there's a trend, you know that there is liquidity. You feel me? Even in real life, wherever like there's a trend in something, there is money in that trend. Like whatever trend it is, you know, there's liquidity in it because people are buying into it.
Yeah.
And it's a trend. You see, so as gold snipers, you go on YouTube and everything and listen to these other traders and stuff. So they'll basically tell you that you must trade the trend, you see. And we don't trade the trend. That's the most baddest advice you can get from anybody. We don't trade the trend.
Yeah.
What we do is we break the trend. You see that? Because the trend is where the liquidity is. So we
Yeah.
basically have to break that trend in order to get all of that liquidity. So we are always looking to be on the opposite side of whatever trend there is. You see that? So us as gold snipers, we are always on the opposite side of the trend. We are for the opposition of the trend. So we won't just go on the opposition at any time or any so there's respective levels at which a trend has to reach in order for the market to be satisfied with the liquidity that is there, and then it can start um going to go take that starting to go take that liquidity, you see. So in this
Yeah.
instance, we have this trend here that has been aligning. So this has been going on since basically like January. So this has been a monthly, last month's trend, and it's been pouring in liquidity throughout the whole month. So it also makes sense since it's January, liquidity is being poured into the market because it's recovering from last year's turmoil and last year's downfall as well. So it will make sense that in January there's so much liquidity being poured in. So with all of this liquidity that is being poured in, we are looking to take a trade on the opposite side. And then that trade will be more profitable because when the institutions and the banks come in to collect the money, they do it very quick so that people won't exit out of their positions and people won't close their trades on the buy side in this term on the buy side as they coming to sell. You see, so it's usually just
Yeah.
a quick reaction, you see. So I want us to go to yesterday's signal that was sent on the Telegram group. So yeah, yesterday's signal, which was sent on the Telegram group. If you can check it as well, we'll check it here. So it was set for here until it broke the trend. So basically, how this trade was spotted was basically that there's a supply and demand. You see that there's a supply and demand. And with
Mm.
this supply and demand, there came a trend after it reached this supply. After it left that demand, came to the supply, it started creating a trend going sideways. You see that? So this movement
Yeah.
was faster than the upcoming movement. You see that? So
Yeah.
we know that this was an institutional move, and then this was when the market was exhausted and they started pouring in liquidity. So we need a trend in order to have
Yeah.
liquidity. And you can see that this movement was a lot slower, and
Yeah.
it wasn't even that big of a movement compared to this fast and short movement here. This fast and short movement.
Mm.
This long movement here, it indicates to us that okay, it is a trend because a trend takes time. It's not something quick. It takes
Yeah.
time. So we know that okay, it's trending back up. So you can even see that it even trending up is what we call a retracement. So this is simply a retracement. So this was just
Yeah.
market retracing or pulling back because the market just doesn't go straight to the point. There's always a lot of in-betweens and breaks and pullbacks. And usually when it does these pullbacks is to bring in more money into the market, in order to
Mm.
continue again, which might be maybe the next day or the next 2 days. So after this slope came, it started becoming a trend. So we identified the trend, so we put the trend. And then as it went, so we're also going to use something called the Fibonacci. So the Fibonacci retracement levels is basically something that indicates to us where what level is at what and what is it respective to, you see. So when we spread this Fibonacci, so it shows us the percentage. So if you can see, can you still hear me? Can you still hear me? Mello?
Yeah, can you hear me?
Yeah, I can hear you. I can hear you. All right,
All right.
sorry about that. Yeah,
I was
so
saying, yeah, you broke off. You broke off after you were about to explain what you did from after straight after you identified the trend.
okay, so yeah, once we identified the trend. So in this point, it's more of a retracement movement. You see, it's not an executive movement. So we're gonna have to take out the
Yeah.
Fibonacci retracement, which are called the Fibonacci levels, which tell us where the market is at, what level it's at, and what level is it respective to after that. So in this point, we took the Fibonacci. So you find the Fibonacci here in your column on your trading view, Fibonacci retracement.
Yeah.
So you're spreading it, and then you find,
Yeah.
okay, so you see here we have the 20%, 0.2, which is 20%. And then we have the 0.35, 35%, and then the 0.5, which is the 50%, and then the 0.65, and then the 0.8, which is 80%. You see that? So in this instance here,
Yeah.
we can see that the market was approaching our 80% range. It was approaching our 80% range. So once it already reacted from the premium, it came back and retraced and tried to go test the 80%, but it came back to the 65, 0.65%. So in the Fibonacci, the most important level is the 0.65, because that is the major retracement level. So if a market moves down and comes back to retrace at the 0.65%, then it's carrying on a bigger movement. You see, so it is the
Okay.
main profitable
Yeah.
retracement level, your 0.65. You see that? So that is how I was able to map out that, okay, this is going back to the 0.65 levels. And then since I saw there was a very valid order block here, as you can see with that spike, there was a very valid order block, and it was a place of interest for many. So once that happened, the market entered that order block. It did a double top, as you can see, these 2 4-hour pins, which is a part of our
Yeah.
formations, which we're gonna go through a bit later on, and then it moved. So that's how we're able to basically see it based on those fundamentals. We're able to see the supply and demand. We know where the discount was, and we checked the Fibonacci. We knew where's the major retracement level, which is 0.65. And then there was all of that confluence at once. So if we go on the 5-minute chart, you'll get to see it much bigger. Let me just refresh quick.
All right. Can you hear me?
Yeah, I can still hear you. So this is the 5-minute chart right here. Just let it load.
So just to recap real quick, that other chart, because it was cutting up a bit. You first found supply and chain, the supply and demand, and
Yeah.
then you looked for the trend in the liquidity, and you saw how like it was you saw how you could get the what you call it, the receding one,
Yeah, the retracement, or yeah, the retracement through the
the
Fibonacci
retrieving one.
levels. Did you
Yeah,
get
and
that?
then you use the Fibonacci.
Yeah, and then we use the Fibonacci. Uh, so on the as I'm going on the 5-minute chart, so I was just trying to show you a few confluences on the 5-minute chart so that you can see as well. So yeah, so as you see, it was respecting the trend nicely, and then
Yeah,
once it reached that level, it reached, so an order block is an area of interest. Basically, that's what an order block is an area of interest where the market has placed and set orders, so order blocks, there's
yeah,
different types of order blocks: retracement order blocks, execution order blocks. We're also going to go on a separate on a separate tour of like what order blocks are. Just that right now I'm just trying to hit the ground fast, and then like the other things will
yeah,
just clarify them as long as you get the idea. So when it comes to
yeah,
order blocks, they are areas of interest where there's many orders there, or where people are looking to enter the market, and either take whatever position they want to take, whether it's buying or selling. You see, that is what an order block is. And in that block, or in that level, is where we are looking to find reactions that will basically validate our forecasting and our prediction on where the direction goes. You see, so that's why we don't trade anything until it gets to an order block, because if it's between there, then anything can happen. But once it's at an order block, it can be that the funds that are poured into the market at that specific level will force the market to go into a certain direction. You see that? So here
yeah,
we have this order here to this order, and you can see that the price has reached that order, and then it's now starting to move a little bit slower, because the market is satisfied and it has reached a point of interest, and then that point of interest is either gonna have a quick impulse reaction, or it is just going to be exhausted and try to collect the more orders into there and try to pour in more people so that they can be more liquidity and try to create another trend, you see, as the
yeah,
impulsive movement destroyed the previous trend. So
yeah,
in this instance, you can see that it broke the trend, which will be a BOT, as we will say, like a break of trend.
yeah,
And once there's a break of trend, there always is a slight retracement coming in, and then we'll get a continuation. You see that? So with this level here, you can see that it rushed all the way there. And once it got into that level, there was a lot of indecisiveness. So when we start to see the market moving indecisively, it's getting ready to make a decision, you see. And once we
yeah,
start to see that it's undecisive at a point of interest, or in an order block, it shows us that it is getting ready to move into whatever direction it decides. And in this instance, once we got the order ready, It started moving from there, and then it was just killed. I want us to go just to check the signal as well. Yeah, signal is here. So there's the signal. It was around about 11 in the morning. So uh it was sell USD chief at the current market price, CMP, which means current market price. You see that? So CMP means
Yeah.
current market price. So we were at it was basically there when I saw it at the current market price, and I sent off the signal. So this is what it looked like at first. Open that. This is what it looked like at first. You seen that order block. So it went up. There was a
Okay.
rejection up there, and this is where we caught it. It came down a bit, and then it went to go test those levels again, and then it just slid off. So this was around about 11, and then I posted the 1 hour chart as well, which was at 11. So this is what the 1 hour was looking like. So it was already rejecting majorly on that pin here on that 1 hour. After you see that big green candle, came a huge rejection, so that is saying that this
Yeah.
movement, this rush of a price here had to be counteracted because it has reached a point of interest. And by that time, they had probably already had enough orders filled into the market. As this was just a retracement, it was gonna move
Yeah.
fast after then. So after that, and then I didn't see that until like the next day because I was busy, but the TPs and everything closed and executed after the order. And then I think this guy Makaramedza, and this guy's
Yeah.
always he's always on the market. This guy, Makaramedza, I think he caught the same trade as well. So and then this was at 12 the next day, and you see that this is where we had it. It came down, retraced, and then there's a lot of indecisiveness. So, but you can see that this huge momentum here, you see this momentum here was not matched as time goes on. So this huge momentum was rejected. So once you see a
Yeah.
mismatch in momentum, especially when the price just all of a sudden starts stretching and then it lacks the consistency in momentum, that means that it was rushing to reach to an order block, you see, because you can see that
Yeah.
it was a sideways trend and like just below that order block until they rushed it until it reached that order block. Once it reached that order block, and then it started creating the double top formation, and then the sell was executed. You see that?
Mhm.
And then if we look at the hour, yeah, here's the hour. So you saw after that rejection, it was just another up, and then yeah, the market just literally poured from there. So now the market came back and retraced these levels, this level here, because this is where the retailer started coming in. You see, this is where a trend was trying to be, made based on the 5 minute chart. This could be seen as a trend, and then it started moving slow again instead of like this fast movement here. You see that? So if we go
Yeah.
there, which was around about here, which was after they broke the trend, that retracement, and then it started moving, sideways like a trend basically.
Yeah.
Started moving sideways like a trend, and then after then they spiked the prices in order to collect all of the orders that were here or kick out the scalpers because the market likes kicking out scalp traders. And then after then,
Yeah.
had a huge reaction, and then the market poured again. You see that? So the price won't just go directly towards here. You see, There has to be a lot happening in between. It has to come, it has to retrace, and then consolidate, collect orders, put in more liquidity into the market, and then continue going. So there's always many opportunities to catch a trade, there's many opportunities if you know the right areas, you need to be looking at in order to see those opportunities avail themselves. See that?
Yeah.
So let's
Order block also gives any indication to a receding trend, right?
an order block gives a
I'm saying, does it give indications to the receding trends?
wait, how so? I'm not understanding.
Like as soon as you put it up and then it reaches, and the trend, the receding trend reaches that point.
That order block, yeah.
Yeah. Is that how it also like reveals that this was a receding trend as soon as it reached the order block, basically?
Yeah. That's how it shows. As soon as it reaches the order block, but you also have to look at the reaction within the order block, you see, which is, did I delete that?
Yeah, like those two up and downs that were happening.
Wait. Where did I leave those notes? Those notes were somewhere there. So yeah, you have to look at what is happening in the order block as well. So order blocks can be invalidated. So for example, order blocks can be invalidated due to momentum as well. So yeah, you're gonna have to check the order blocks. So anything can happen in that time of day, which can cause that order block to be invalidated. So for example, with this one here, we had this order block here, which was NAS 100. And in this NAS 100, the order block got invalidated by this huge momentum here. So this was some unexpected momentum. And when this happens, it invalidates the order block. Or it can be an act of
Yeah.
inflation as well. You see that? It can be an act of inflation, which causes the price to go higher than expected due to the number of people in there, the money and the volume and the volatility as well. You see, so
Yeah.
it will cause the market to inflate, even invalidating the order block at that time. And if there's enough liquidity for the price to keep going up, then the price will keep going up until the next valid order block, until the next valid order block. Bro, when the meeting kicks us out, we'll